Because of the dollar's decline, oil prices are moving up. Greg, I know that gold is seen as a hedge against inflation, but is inflation or hyperinflation the bigger risk now? And what is it going to mean for gold prices in, say, the next 6 to 12 months?
Yeah, I think that if you just follow the theory of the various central banks printing money around the world, it has to be inflationary. But the other thing about commodities, gold, it's not just an inflationary hedge, it's a crisis hedge. And it's also a store of wealth, Kathy. If you look at an ounce of gold 30, 40 years ago, it's still buying you the equivalent in corn, wheat, sugar, oil. So it's maintained its wealth. If you look at the price of a barrel of oil relative to corn, sugar and wheat, something that we consume, the exporters of oil have to actually be selling more and more oil, and they're actually getting less and less food, which is an interesting dilemma. But gold should be in a portfolio, particularly with the environment we're in. I don't think we're out of the woods yet, and it is a crisis hedge.
Now that you mentioned food, agricultural commodities are seeing some pressure now from that favorable weather we're getting. Soybean futures down over 9%. Just this month in corn and soybeans have fallen in July because of those bullish crop prospects. I mean, great weather, not so great for the ags, but what's the upshot for these commodities?
I like the ags, and I'm glad you asked me. We saved the best till last. Remember that these agriculturals, the grains, went down sharply because of the planting commitments of US farmers. And the issue we now face is it's basically the start of summer. And there is no pricing in of any adverse weather. And they're assuming that because they've got a large acreage and we have perfect weather, well, we're going to see prices at these levels or lower. But I think the issue you need to consider is that if the weather's hot, we have too much rain, not enough rain, we don't have surplus inventory to justify the sort of sell-off that we have seen in the grains. And the other thing is that we continue to consume the grains. They're inelastic. And with corn in particular, it's competing food for energy. And so if the energy prices start to move higher, corn will be driven by that as well. And so there's a number of fundamental scenarios, big ones, starting to play out in the grain markets. The other thing is what we call the global float. It's the excess grains after the country that is growing them satisfies its internal demand. That float is actually being accessed by more and more countries. Saudi Arabia's cut back their agricultural program. the Iranians are importing more. And so if we have any adverse weather in China, Australia, the US, well, then we're going to see these markets sharply higher.
Okay, you mentioned corn and you mentioned sugar earlier before we went to the break. I know that sugar has been among the best performing commodities this year, up about 45%. Don't you think prices already reflect that kind of a run-up?
No. No. In short, Kathy, no. What they're saying at the moment is that we have a reducing inventory, but that inventory is continuing to decline. We're now... One thing to bear in mind is days of consumption, like how much do we have in storage left? And sugar is now getting down to 1994 levels. And so when you see the price action back at that time, you can see the prices were sharply higher than where they are now. And that is one market because it's competing for food and energy. That again, if the grains move, it'll follow them, and if crude oil moves, it'll also follow it up. But the fundamentals, the planets have all lined up for sugar.
Oh, we'll save the best for last, as we promised. You like sugar as well as oil, and not to forget corn. Thank you so much for joining us for those picks there. Greg Smith of Global Commodities in Singapore.